Gold was up about 1%. Silver was up 2.4% on the week, still down 20% on the year, but it's enough to create a buying opportunity. And in fact, a lot of people got scared that the war was going to be bearish for gold, that rising interest rates were going to be bearish for gold, and they are wrong. They're actually bullish for gold. We're going to have a crisis either way, regardless of whether Japan does the right thing or the wrong thing. It's a problem for Japan, and it's ultimately going to be a bigger problem for us. First-time claims for unemployment benefits dropped by 22,000. They're down to 187,000 claims. Trump said we have the worst economy in history under Biden. We must have a very strong economy to have a labor market so strong that hardly anybody is being fired. Trump is now imposing tariffs on about 60 different countries, ranging from 10 to 12.5%. It's based on Section 301 of the Trade Act of 1974. Protect American workers from competition with slave labor. China and Switzerland aren't doing anything to protect against slave labor. And there's been a lot of bad news, too, that came out this week. I'm going to get into some of that bad news after I do this break. But before I do that, I want to turn my attention to markets that were positive on the week, and that is gold. Gold and silver, precious metals, had a good week. Gold was up about 1%, nothing spectacular, but gold rose 1%, even though bond yields rose significantly, and even though oil prices rose significantly. Now, you might say, rising oil prices, should be good for gold because gold and oil should be correlated, but they haven't been correlated recently. Ever since the war broke out, the Iran war, there's been a divergence. It's been opposite. Gold and oil have gone in the opposite directions. And I've been saying that eventually that's going to change and oil and gold are going to move in the same direction. And that might be happening. Now, we didn't have a big move in gold this week. We did have a big move in oil, but gold didn't go down. And the fact that it didn't go down and in fact managed to rise, I think shows that that is happening. And that is very significant for precious metals investors. And look what happened. Silver was up 2.4% on the week, still down 20% on the year. Gold is barely down on the year. No, excuse me. It's down about 7% on the year. But considering the huge gain that both metals had in 2025, it's not that big a decline.
Markets celebrated higher yields, yet gold quietly refused to obey the old rulebook. Peter Schiff notes that gold still gained about 1% despite rising bond yields and surging oil, exposing a shift and many investors are overlooking. When a market stops reacting the way consensus expects, institutional positioning is often changing before headlines catch up. Wealth preservation starts by watching broken correlations, not television narratives. Next, Peter Schiff reveals why this changing relationship between oil and gold exposes a deeper shift institutional investors are already pricing in.
But it's enough to create a buying opportunity. And in fact, a lot of people got scared that the war was going to be bearish for gold, that rising interest rates were going to be bearish for gold, and they are wrong. They're actually bullish for gold. And this week may be an indication that investors are figuring that out. In fact, if you look at what happened to the mining stocks, GDX was up 5.6% on the week, and GDXJ up 5.8%. These are decent moves where gold was only up 1%. A lot of leverage this week in the miners relative to the metal. I think that's a good sign of a bottom, that we're moving a lot higher. These stocks are still great buys. They're down on the year. The GDX is down 12.25% so far this year, and the GDXJ is down 14%. And another week where Bitcoin didn't really go anywhere. We're going to have a crisis either way, regardless of whether Japan does the right thing or the wrong thing. It's a problem for Japan, and it's ultimately going to be a bigger problem for us. We are more dependent. Even though we have a smaller debt to GDP, we are less able to service it, and we have the problem of being a debtor nation. We are not a creditor nation. The U.S. government doesn't have a lot of wealth other than from the very, very rich, right? You got the 1% of the 1%, but the middle class Americans don't have the resources that the middle class Japanese have.
Mining stocks surge more than 5 times faster than gold. Yet that rarely becomes the headline. According to Peter Schiff, GDX and GDXJ outperforming the metal itself suggests investors with higher conviction may already be positioning ahead of a broader move. Retail attention remains fixed on daily price swings, while institutions often accumulate during periods of pessimism. Next, Peter Schiff exposes why Japan's debt dilemma could become America's financial problem much faster than most expect.
Which is why we're even less likely to do the right thing and more likely to get hit with runaway or hyperinflation. But the Japanese may reach that decisive moment even before we do. But then it'll be just like dominoes. It'll start there and it will quickly morph to the United States. Anyway, I want to get into some other economic news in the United States. One was the unemployment claims, because the Trump administration has been making a big deal about the drop in claims for weekly unemployment benefits. And that is true. There was a significant drop. The most recent week, first-time claims for unemployment benefits dropped by 22,000. They're down to 187,000 claims. Now, the Trump administration is out there saying that this is the lowest level since 1969. Now, that's actually not true, because it was actually lower, 182,000, in September of 2022. So they want to ignore that year. Obviously, the reason why is because they want to tout this as some phenomenal Trump-related accomplishment, that Trump has managed to achieve something that we haven't had since 1969. But the fact that it also happened in 2022 means that Biden achieved the same thing, which diminishes the success. Because if Biden had a number even lower than Trump, because Biden said we had the worst economy in history Trump said we had the worst economy in history under Biden. Yet we had a week where unemployment claims were lower than the week that we just had. But even if you throw that out, it's still a very low number. And people might say, oh, well, I should be giving Trump credit where credit is due.
Low unemployment claims can disguise deeper structural weakness rather than confirm economic strength. What Peter Schiff is highlighting is that the celebrated 187,000 claims lose significance when similar or even lower figures appeared just a few years ago. Selective comparisons create political victories while masking broader economic deterioration. Smart investors should question why inconvenient data quietly disappears from the official narrative. Next, Peter Schiff unravels why today's labor market looks healthier, only because the rules underneath it have fundamentally changed.
We must have a very strong economy to have a labor market so strong that hardly anybody is being fired. After all, it must be a good economy if employers are not letting people go, because normally, you let people go when the economy is weak. And because no one's getting fired, or not that many people, then we must have a strong economy. And I think that misses other significant changes that have occurred in the labor market in recent years that render that number a lot less significant than what it used to be. One is the fact that we've had such minimal hiring over the past couple of years. Companies have barely hired anybody. In fact, they may have not hired anybody at all. But even if you believe the government numbers, there's hardly been any hiring. And those numbers could easily get revised to show that there's just been firing. But the point I'm making is, if companies are not hiring a lot of people, it stands to reason they're not going to be firing that many. Because a lot of times you hire somebody and they don't work out, right? There's somebody new, you take a chance, you don't really know, and they don't work out, and so you let them go, and you hire somebody else, or maybe you find out you didn't really need that person. But we're not having that. We're not having that type of firing because we're not having the hiring. So that right away diminishes the number of people that potentially could be laid off and could be filing for claims. The second thing is the collapse in labor force participation, which has continued under Trump. If you have fewer people in the labor force then you have fewer people.
A quiet hiring freeze often signals trouble long before layoffs dominate the headlines. Peter Schiff's argument suggests that weak hiring naturally suppresses future unemployment claims, making today's labor data less reassuring than it appears. Markets frequently misread delayed economic effects because official statistics lag real business decisions. Protecting wealth means recognizing what companies have already stopped doing before recession headlines arrive. Next, Peter Schiff reveals why shrinking labor participation quietly distorts one of America's most trusted economic indicators.
Who potentially could be laid off and collecting unemployment benefits, because you have to be fired and you have to be looking for a job to qualify. Well, if you haven't been fired or you're not looking for a job, obviously you can't file for unemployment benefits. So it makes sense. Fewer people in the workforce, fewer people filing unemployment claims. And a third reason that I think these numbers are insignificant is the sheer number of Americans who are now working, but they are self-employed. They're working through the gig economy. An example would be, somebody who's driving an Uber. So if your only occupation right now is Uber driver, you can't get fired. If Uber employed all of these drivers and had them on payroll, and let's say demand was falling for rides, they weren't getting as many rides, they needed to cut costs, they would lay off some of these drivers. And now these drivers would go and, submit for unemployment. They would file a claim because, hey, I just got laid off from Uber. I'm going to get my unemployment benefits. Uber doesn't have to do that because nobody is on salary. Uber drivers only get paid for the rides they perform. So it wouldn't make any sense for Uber to fire anybody because it doesn't cost them anything to keep people in as drivers. What happens is instead of some drivers losing their jobs, all drivers just drive less. And so the pain is spread out among everybody. You don't have some people that do no driving. Everybody just does a little bit less driving if there's less demand. And so you don't get the layoffs and you don't get the unemployment claims. I mean, if you're self-employed, by definition, you can't fire yourself, right?
The gig economy can hide economic weakness without eliminating financial stress for households. This is where Peter Schiff's thesis shifts from unemployment statistics to how work itself has fundamentally changed. Millions can experience declining income while official layoffs remain unusually low, creating a misleading picture of economic resilience. Investors relying only on headline employment numbers risk missing growing pressure beneath the surface. Next, Peter Schiff exposes why today's unemployment rate may conceal far more weakness than it measures.
So these gig workers have not been hired by Uber, they're not going to get fired by Uber, and they're not going to be getting unemployment benefits. And in fact, even if you're still working, but you're working less, that doesn't count. You can't, you're still employed, you're still performing work that would disqualify you from unemployment benefits because you have to not be working. And that's why the unemployment rate, too, is so meaningless, because we count people who drive Ubers maybe a few hours a week as not being unemployed. Even if they spend the rest of their hours looking for a job, they still don't count as being unemployed because they earn some money driving an Uber. And people didn't have that opportunity years ago. So a lot more people who were unemployed were qualified as being unemployed. So the number is meaningless. And I think Trump going out there and the Trump administration making a big deal, they're making much ado about nothing. Now, the other big story on the week are the new tariffs that Trump is imposing to replace some other tariffs that just expired. Not the reciprocal tariffs that were declared unconstitutional, but this new tariff that's also unconstitutional. I don't know if we're going to have to wait or how long we might have to wait for some legal challenges, but they will be overturned as well. So Trump is now imposing tariffs on about, 60 different countries, something like that, ranging from 10 to 12.5%. And it's based on Section 301 of the Trade Act of 1974. And what this section is supposed to do is protect American workers from competition with slave labor.
Headline employment figures can improve even while household incomes quietly deteriorate beneath the surface. Peter Schiff notes that modern labor metrics increasingly classify struggling gig workers as fully employed, creating confidence unsupported by financial reality. Policymakers celebrate statistics, while families absorb shrinking purchasing power and unstable income streams. Next, Peter Schiff reveals why the legal justification behind new tariffs contains a contradiction that few commentators are discussing.
The idea is that if a country is forcing people into involuntary servitude, coercive labor, they're not hiring workers in a competitive free market and paying a fair wage, that it's unfair for American workers to have to compete with that, or American companies to have to compete with a foreign company that has the advantage of enslaving their workforce. It wasn't so much that, we're so concerned about the plight of these slaves. That wasn't what was politically driving it, although, they may have used that as part of the selling point. But it was more an economic argument. Hey, let's help American workers. It's not fair if these businesses have to compete because, we don't have slavery in America anymore. And so we can't compete. Now, that's beside the point that slave labor, to the extent that it exists, is not very efficient labor. It never was. I mean, a slave doesn't work very hard. In fact, the slave does the minimal amount of work that he can get away with. Whereas in a free market, absent like a labor union or something where you can't get fired, people work harder because if they don't work hard, they're going to get fired. A slave isn't worried about getting fired. He wants to get fired, right? To the extent that that's even possible. So in a free market, the workers work hard to keep jobs that they want. And they work even harder because they hope they get a raise. They hope they get a promotion, right? What's the point of getting a promotion when you're a slave? What, you just get to work harder, but you're still a slave? You don't get any money? So it's an inefficient labor, system, slavery.
Policies often sound moral until their economic logic begins falling apart under scrutiny. According to Peter Schiff, the stated justification for these tariffs extends far beyond genuine concerns over forced labor. Once governments stretch legal definitions to support broader policy goals, investors should examine incentives instead of speeches. Next, Peter Schiff unravels why applying these tariffs globally creates contradictions that become impossible for policymakers to explain away.
But apart from that argument, because that's irrelevant to the point that I'm really trying to make. So it was an economic argument that it's not fair. If you're not paying any wages, it's unfair competition. So it allowed the president to impose tariffs on these goods that were the product of slave labor. That is the provision that he is relying on, Trump, to impose these tariffs now on all these countries. He's saying that we're doing it because of slave labor, except there is no slave labor going on in these countries. I mean, there have been some allegations that there's some slave labor potentially in China somewhere, but the tariffs in general have nothing to do with actual slave labor. The way Trump is justifying this is he's saying that we are imposing these tariffs on countries that are not doing enough to prevent the products of slave labor from coming into their countries, even if no products associated with slave labor are actually coming into the countries. According to Trump, it doesn't matter. He's going to use this to impose these tariffs anyway by claiming that these other countries aren't doing enough. Now, the difference between the 10% tariff that Canada is getting, for example, and the 12.5% that China is getting, that Switzerland are getting, is Trump is saying that China and Switzerland aren't doing anything to protect against slave labor, while Canada is doing something, they're just not doing enough. And all this is complete BS. I mean, think about Switzerland. Do you think the reason Americans are buying Swiss products is because they're being made with slave labor? No, not at all. In fact, the average wage in Switzerland is higher than the average wage in America.
When policy explanations require increasingly creative logic, investors should question the real objective. What Peter Schiff is highlighting is that applying slave labor tariffs to wealthy economies like Switzerland strains credibility beyond recognition. Official narratives become less convincing when economic facts directly contradict the legal justification being offered. Next, Peter Schiff reveals why these tariffs may ultimately burden American consumers more than the countries they're targeting.
They're paying higher wages. So any competitive advantage that Switzerland enjoys in their products has nothing to do with paying low wages, because they're not. They're paying high wages. There are other things that are involved. And again, it's all BS, because Donald Trump is saying this is being done to protect American workers, protect American companies. No, it's not. It's not working. The trade deficits are bigger than when Trump was elected. They're not smaller. There are fewer people employed in manufacturing since Trump was reelected. Not more people. They are backfiring. All these are taxes. They're taxes, and they're on Americans. They're not taxes on the Swiss. They're not taxes on Canadians or the Chinese. These are taxes on Americans, and Americans are paying these taxes. Now, Americans need to pay taxes because we have a massive deficit. So the government needs more tax revenue. It's just disingenuous for Trump to claim that these taxes aren't being paid, to just take credit for lowering taxes on tips, lowering taxes on Social Security or Medicare, but not accept responsibility for taking back a good chunk of those tax cuts with tax hikes, which is what these are. But the way they're being done, they're actually making American businesses less competitive, and therefore they're worsening the very trade problems that they're trying to solve. And they're not doing much about the deficits. The deficits are still going up because we need bigger tax cuts or bigger tax hikes than the ones that we've had. The tariffs are too small to make a big enough dent in the reductions in taxes. And the deficits that already existed before the big, beautiful bill made them bigger. And of course, what we're really missing is cuts in government spending, because not only did we not cut government spending, we increased government spending. The problem when Trump was elected was that the government spent too much, and Trump acknowledged that.
Trade deficits remain elevated despite years of tariff escalation, challenging the promised outcome. Peter Schiff's argument suggests tariffs function more like hidden taxes on domestic consumers than penalties paid by foreign exporters. When higher costs reduce competitiveness instead of restoring it, long-term savers absorb the consequences through weaker purchasing power.